I'll start with this. All right, welcome everyone. I guess this is the first session. So this is about the grind. We're going to talk about the grind leading up to raising money, and we're going to talk about raising money. So today I have Natalie Abasena of Scope AI, Jack Altman of Lattice, and Eric Murphy-Kritorian of Eighth Wall. Why don't we just do a minute and talk about what your businesses do?
So I'm Natalie. I'm the co-founder and CEO of Scope AI. So Scope AI is a platform that analyzes customer conversations using natural language processing, and we help teams find product and operation insights.
Oh, I think I'm Jack. So I'm the CEO and founder of Lattice. So we make modern performance management software. So we give tools for goal setting, 360 performance reviews, employee feedback. We started the company in the end of 2015, and today we have about 700 customers. We're about 35 people, and that's kind of what we do.
My name is Eric Murphy-Kritorian. I'm the founder and CEO of Eighth Wall. Eighth Wall is a technology company, and we build a developer platform for mobile augmented reality. So we take today's best computer vision and machine learning and turn that into SDKs and services that developers can use to build AR experiences on mobile phones.
Awesome. So these guys have a pretty impressive track record and background. Scope has raised money from Y Combinator, Menlo Ventures, Social Capital, right? Lattice has raised from Thrive, Slack's venture fund, and Khosla Ventures, among others. And then Eighth Wall is raised from Norwest and friends and family. But it wasn't always this way. They didn't, emerge into life as funded startups. Let's touch for a few minutes on kind of, how you got the business going before you were funded. How did you finance it? And, kind of about that starting point. You want to start?
Sure. So starting off, it wasn't, my co-founder and I were friends. We started working on it as more of like a side project. Didn't really have plans to start a business, but pretty quickly we realized that there was a pain point in the space we were working on, and we really enjoyed working together. There was a really good fit, skills and intellectually. So we worked on it for about 2.5 months, unfunded. I was basically living off of savings, and then that's when we applied to YC. So that was our first source of funding and kind of how we officially kicked things off.
Jack, how about you?
My co-founder and I had worked together at a company called Teespring before, which is an e-commerce company. So my co-founder had been the head of engineering. I'd been the VP of business and corporate development. When we left because we felt this pain of people management, cultural challenges as you grow. And so we left starting with this goal-setting product, but it turned out that was not the right product. And it actually required 2 more product launches over the ensuing year, when it was pretty much just me and my co-founder sitting in each other's apartments, writing code, talking to customers, getting anybody we could to talk to us, until we got sort of the product that had a connection. And so in a lot of cases, I think startups build a thing and then they sort of iterate their way to product market fit. I think for us, it was actually just a sort of flip switch when we launched a thing that had that instant product market fit. And so that first year for us was just the 2 of us just trying to figure anything out and find any momentum at all. We were able to raise a seed round in the midst of that, and I'm sure we'll talk about that more, but that was kind of what the first year looked like.
So maybe just a little bit different. So my background, I did computer vision in academia. I did a PhD, and then I worked for about 10 years at Google and Facebook. And I did a lot of really neat stuff, some applied computer vision and product development. And at Facebook, I was doing images and photos and GIFs and other pieces. But actually, if you go all the way back to my academic work, I was doing some AR-based computer vision and face tracking before this was ever a thing. And in all honesty, I never envisioned this was going to be a kind of a hot area of technology 10 years later. But as it became more and more interesting and like this technology really could start working on everyone's devices, I wanted to start getting into it. And so I did my diligence looking around like who's really focused on mobile AR. This was the end of 2016. And I think what we were just seeing is the end of the kind of VR headset-based revolution where all the emphasis was on things on your face, like goggles or glasses or cardboard. And after kind of doing that, I was realizing like there really is this opportunity to take this technology, put it in the hands of developers and get it out to real people. And why not just go do this? And so I left my role specifically to start this company. spent a few months coming up with what is the right way to best accelerate the space. And then, yeah, from there, went to fundraise and pitch it and started the company.
No, that's interesting. Do you have a sense, maybe Eric, will stick with you, because I think this is always interesting, just to put it in perspective for first-time founders, which I'm sure is probably most of the audience. Like, how much did you put in of your own money before you took outside money? Are you willing to share that? Because it's always interesting. People are, it's sometimes kind of shocking how much it actually takes to get to a fundable state.
So, I mean, when I left my job and started this, I self-funded myself all the way up until when we raised our first funds. And so I'd say there was about 4 months just off of my personal savings. And then we raised funds, and I didn't count myself as an employee for another month or two. So I'd say just under half a year of time. But I did this, I mean, I'd been working for 9 years before that, and was able to use that to kind of have built up enough. But.
And Jack, do you have any numbers around that before you took that friends and family round? Like,
yeah, it was similar. I mean, I went a few months without a salary.
Yeah.
And then when we did take one, it was, a fraction of what we had been making before. The thing, though, I think is that I think a lot of people think of starting a startup as a much riskier endeavor than it is in reality. I think there's a lot of ways in which the things that seem the riskiest are actually the least risky, and there's actually, for example, a big risk to not starting a company if that's sort of in the realm of things that you want to do. And so I thought of risk a little bit differently. And so while I didn't have like the cash flow for that period of time, I didn't see it as this deeply existential risk given sort of like my life circumstances and not having kids and other things. So of course the considerations are different, but I do think that reframing how you think about risk is a helpful exercise.
yeah, that's interesting. It's the kind of a cliche, right? On your deathbed, you regret the things you didn't do more than the things you do, right? Might apply to starting the startup or not. Interesting. And so the two of you both got into Y Combinator. So maybe let's see, December 2000. Were you guys in the same time or different times? Different batches?
Different, yeah. We were winter 16 and they were winter 17.
Okay, gotcha. So maybe let's touch on that because I think obviously that's pretty impressive. But how, let's start getting into fundraising. How did you, Natalie, really kind of leverage your time and experience in YC to start to get investors interested? Like, what was the process like?
Yeah. So our time in YC, we were pretty early product development. So a lot of that was working with the network of companies that were in our batch and outside of the batch too. In terms of how we interacted with investors, at that point we were early enough that we didn't feel we were ready to completely fundraise and pitch. We wanted to spend a little bit more time developing our vision. So what we did really from YC was get introductions to investors. We did pitch on demo day, but a lot of that was we started a connection, and over the next 6 months or so, we made some traction, and it was much easier to fundraise at that point because of those early intros.
So
Yeah.
demo day was, I guess we could almost lean in like this. Demo day was in many ways kind of the start of your fundraise, not the culmination of it, which I think is the expectation of a lot of startups, right? So you said, I think it mentioned it took about 6 to 7 months before you were able to raise money. Were you actively kind of hustling and fundraising and getting introductions that whole time, or what was the?
It was kind of two ends. So the first was we did get a lot of introductions from YC. That was the earliest conversations we had, and then about a month before we wrapped up the round was when I started really engaging with investors again. In the middle, there was a bit more of like updates. So if we figured out that we actually want to work with customers of this size versus this size, I would talk that through with an investor that I thought was an expert in that area, which started to create a bit of like rapport too. So when we actually went in to ask for a check, they had seen our progress. They were pretty impressed with what we'd done in the small amount of time and with the limited resources. Yep. So it was a lot easier to fundraise. Yeah.
Do you have a sense of how many investors you talked to like throughout that time? Because this is always an interesting thing. I think many founders underestimate how many investors you actually have to build relationships with and court before you end up with a good handful.
A lot, for sure. I would say at least 30 loosely, and then maybe a little under 10 more seriously, so ones that I kept in touch with. Our round was also comprised of a few angel investors, some institutional, so there was a bit of mix there, but I would say around 10 seriously, yeah.
And Jack, how did you work YC, how did you work YC?
So I think one of the most valuable parts of YC is the help with fundraising, and specifically, I think it's the fact that fundraising is this very unintuitive thing that you don't normally see in other areas of your life. It's not magic; it's just unusual. And so, if somebody can teach you sort of the dynamics of it and the pitfalls and the ways to run a good process, it can skip so many steps. And so I think one of the most useful things YC does is it really prepares the founders well for how should you go about your fundraise. The good news is all of that information is online, and a lot of those techniques are, at this point, I think, common knowledge, but they're easy to forget, especially when you're in the middle of it. So one of them is definitely talking to a shocking number of people. And what goes along with that is, obviously, along the way, you're going to hear a lot of no's. And remember, one of the things they told us in YC that I think is very true is anything you hear besides a yes is a no, don't take it as more than that and just move on. So people will tell you the market isn't big enough. They'll tell you the founding team doesn't have enough experience. They'll tell you that they think you're too early. They'll tell you they think they're too late. There's all this stuff. And the goal for you as the founder is to just remember that you're running a sales process. Remember that it's a funnel. Always be polite, but be confident and just move on. That's a big piece of it. The other thing I think that's really helpful to remember is that there is only one of you. And this is an advantage. So it's a market. It's a supply and demand market. And you certainly need their money to keep going. But there's only one of whatever you are. You might have competitors that are similar, but there's only one of you. And so the dynamic that you want to create is that this round is going to happen once. That's then going to be taken off the table, and you need to sort of create a competitive dynamic of some sort and able to do it well. So those were sort of the advantages I think YC gave. Obviously, also having demo day and getting to start off your funnel all at once is very helpful. But I think those fundamentals apply always. I think they applied then. They apply for us now in companies that are much larger. So I think those principles are really good.
Yeah, it's interesting. This is a topic dear to my heart. Not to plug Founder Suite, but it is a CRM for managing that funnel. And one of the things I always talk about is like, it's a numbers game. You need a healthy top of the funnel, which usually means a couple hundred people in your funnel. And then it's all about generating momentum, and then eventually that momentum kind of plays into the fear of missing out that investors all have, right? Every investor's lost out on a deal they wanted to get into, that there were more investors interested that they could get in. So you're trying to create that urgency, the momentum, and that FOMO kind of interesting stuff. Eric, let's talk about you. Some of the things we talked about in our pre-call was, raising money when you did not have a finished product. How did you kind of overcome that or compensate for that? And also raising money as a solo founder, right? You have things that you had to kind of compensate for when raising money. You want to touch on that a little bit?
Sure. I mean, one of the things we're doing at Eighthwell, we have a very technical company. We built a lot of low-level machine vision and computer vision stuff that turns into a product when you add a whole lot more. But I mean, it was clear from day one, it was like you needed a team of at least 5 for about 6 to 10 months to get to the first product that you could show. And this is this is very different, trying to get those people to go start a company and co-found this, when really I found timing was the essence to try to get this out. So in my case, I mean, so I had a very strong technical background, which I think is able to help kind of maybe prove out some of the ability to do this. But there's this really interesting conversation you have with investors, and it's like, maybe even more so than other companies. Here's this thing we're going to build. This is what it's going to do. This is why it's important. But there's this level of trust that you're going to get to the finished product. And I think for the unsuccessful conversations we had with investors, a lot of the things were conversations back and forth about, how do I know you're going to actually build a team? What if it turns out no one joins your company? Or what if it turns out that you don't actually get to a product? Or what if it turns out, and as you run through these, it's not that people are worried that you're not going to be able to do it, but they realize that's a risk, and it's a risk to their investment. And they're looking for certainty to show that you'll get to those milestones, but it's very hard to provide those. And so I'd say, you do have to continue to talk to a lot of people, have these conversations, find the ones who are willing to bet early or believe in what you're doing or have prior experience that leads them to believe that's the right thing. But at the same time, just casting a wide net, having these conversations go, and ultimately, when you close these deals, you really want to have a network of people who are all coming in at the same time, who are supporting each other, who are supporting you. And I think that's my experience. But again, for everyone, it'll be a slightly different set of, there'll be things you have and there'll be things you don't as you're trying to push into this race, and figuring out what are your strengths, knowing what your weaknesses are in this, and being able to really speak through them and add confidence to these investors.
Interesting. Jack, let's go to you for a minute. You mentioned backstage that kind of what the hard part was after raising the seed, prior to the raising the Series A, kind of this, some people call it this valley of death sometimes, but maybe talk about that period, like what was going on in your world in between seed and A.
Yeah. So I think this is not an uncommon story where you start to get an early team together, like you were just talking about, and you have the beginnings of a product, and there's something that investors can have confidence in to take an initial bet on that is nothing close to a real business. And you can often make that case, you can get there, and people will sort of believe in you and take the bet. And sort of by nature of those early rounds, odds of failure are still extremely high. And so for us, after we raised that seed round, we still didn't have product market fit. We didn't have something that was truly working. There was interest. We were near something. We had certainly glimmers of like real hope. But you then get to this phase a couple months after that where you're like, oh wow, we raised a lot of money. It's real now, and we don't yet have the thing. And that's a challenging psychological time, I think. And I think in general, one of the biggest psychological challenges of being a founder, of which there are very many, as we all know, one of the biggest ones is this need on one side to be this sort of like rock for everybody, to be the sort of steadfast visionary that is always always assured of what's coming next and always believes in the mission. But then at the other side, you have to be deeply skeptical and deeply paranoid, and you have to be always willing to deep down question everything, or else you actually won't make it. And so that sort of dichotomy that was how I would describe that period. And when you don't quite have it, that it eats at you. But that's part of what you sign up for. That's part of why not everybody's able to do it. And that's kind of the fun, and that's sort of where a lot of, I think, the character is built and the satisfaction is had. So I appreciate that time a lot, but that was what was hard about it.
So you raise the seed money. That gives you a finite runway to kind of figure it out and get to product market fit. Were you just trying different experiments, measuring? I mean, what was the actual kind of like day in, month in, month out process like, trying to get to that product market fit, which is, yeah.
So I'm going to sound like a kind of like a YC advertisement here, but the answer, I think, at the beginning is just talk to your customers. So once you're a larger company, you can start thinking about strategy and the market and competitive dynamics, and you can start like playing chess a little bit more. But at the beginning, you really are just trying to make anybody happy. You are trying to make anything that anybody will pay you for and proudly be happy to pay you for. Like, that is the beginning. And so when you don't have that, you have to be extremely and ruthlessly honest with yourself that, like, people are being nice to me, or they're kind of just like not wanting to exactly say no, or they're using it, but like I can tell that in 3 years they're definitely not going to be using it. Like, you can like figure those things out. And so for us, we talked to our existing customers because we had people who were nice enough to not just shun us and who were using it and trying it. And we said, okay, like we need to go a different direction. Like, what do you need? What other problems can we solve for you? And so for us, it was just the tactical, how can we make 10 people love us and nothing else matters? And that was a couple other product iterations until we got one that was like, we're not just asking you to buy this because we want to support you, because we need it.
Yeah, no, that's interesting. When I raised our seed round for Founder Suite, we had people signing up but not engaging on the product, but it was still enough of a signal to raise money, and then we took that money and completely rebuilt the thing, and now we have engagement, right? But it was still pretty frightening for many months of like, oh shit, did I just like sell a house of cards to some investors, and can I build the foundation to build a house now, right? And fortunately it worked out. Natalie, let's go to you for a minute. One of the things you mentioned was when fundraising that you were really trying to find investors that invest in companies that look like you or look like your company. What did you mean by that? Maybe kind of talk about that.
So what I meant by that was I found that it was less of an uphill battle to find either investors who understood your space or understood what the risk profile of investing at the stage that you were at. So for us, that was another place where the YC community was really helpful. We had a lot of friends who were also founders at this point, and we saw the investors that took a risk on someone. So to give you an idea, like our profile, we were both first-time founders. We didn't really have domain expertise in what we were working on, and also, relatively early in our careers. So we wanted investors who understood what that profile looked like and the things that we'd need to learn and we'd need advice on. And so finding other companies that investors had invested in that were similar was what we kind of zoned in on, and I found that was a lot easier. You didn't have to overcome that on top of all the other questions that they'd ask. So that's
What were some of the characteristics of those companies?
So typically it was about the same stage as us. There was some early validation that there's customer interest, but typically it was more of like a logical reasoning that there was an opportunity here. So in my case, I actually did what our platform does in my old job. So every day I would transcribe user interviews, codify it, find trends, and what correlates with this customer preference, so on. And so for me to go into those investor pitches, I was saying, I know this problem exists, and I know that there needs to be a solution for it. We haven't really quite figured out where in organizations this is going to sit, but we know this. Very similar, so some of the other companies that introduced us to investors would be in a similar space where it was, we know there's a pain point here, I've built this in-house before, that's where we want an investment, we see an opportunity. So that was it was usually the idea and stage combination. Yeah.
Nima, how are we doing on time? 8 minutes, okay. And are we doing audience Q&A or depends? See if I run out of questions. Jack, maybe turn to you for a sec. I was looking at your profile. You've made some angel investments in some pretty interesting companies, Soylent and Instacart and Patreon and Gusto. First of all, how'd you get into those deals? Is this the YC network again? But second of all, what are some commonalities you see in these companies that you put money into?
Yeah, so this is before Teespring. I was doing seed investing. And the way we got in was because it was really early before other people cared to get in. What you don't see on the profile is that there were a lot of investments that didn't work. Sure. And so that's sort of the nature of it, is that you make a lot of investments at that stage, and so some of them work out, and of course, the majority don't, but some of those also then became second-time founders quickly that we made investments into that were great. I think that's one of the good reminders, actually, for founders going out to fundraise now, is that a lot of these companies that later became the hottest company that everybody wanted to be part of, that you couldn't get money into if you tried, there was a time when everybody passed on them. Like all of those companies that you named, like nobody wanted to invest for a really long time. And so that's the case with all great companies. And I always remember, I always try to remember that, and that there's, you think of any great company, Airbnb, Facebook, all of these companies struggled really hard, and lots of really smart investors passed on them. So that's like one of the things to remember, is that any investor that says no to you, like, might have also been the investor that said no to Airbnb. Like they're no more right than you. So I always take that to heart.
No, it's good. I think, is it Bessemer that has their greatest misses? Yeah. One of these VC firms has like their greatest misses on their website, which is it's pretty fun to read those.
The anti-portfolio.
Anti-portfolio. Awesome. Let's see, just Eric, maybe close out for you. So you've raised a seed in Series A, and then kind of just going forward, are you raising another round yet? Are you thinking about that yet? The expectations obviously rise for every new round you raise. So how are you thinking about funding strategy going forward?
I mean, it's funny. I think about this every day, but I think about it kind of for a little further down the line. It's like, what does it take to get to the B round and that next level? And I think, for the seed in the Series A, all these questions about team building and product market fit and getting something out there and bringing your technology to people. And I think getting to the next level, there's a really big component around traction. How many customers, are you hitting your KPIs? Are you getting to these levels? Are you able to have the kind of relevance in market that you're after? And for a company, especially like tech-focused company like ours, it's even a bit of a departure. It's like a whole additional part of the company needs to get built out around business development, customer success, and really like focusing on building that community. So I think about this all the time. We work to do this, but it's at the same time, it's also, you sit in this position where in the future, you know where you have to be. You set these goals. The goals are really high, and they always seem unattainable until they've been attained, and then you just have to focus on that and push on it.
Good. All right. 5 minutes. Okay. I'm going to go down just one last quick question. Maybe start with you, Natalie. What piece of advice would you tell your younger self if you're doing this all over again, either about the grind or fundraising, or just general advice?
Yeah. I don't know about younger. I mean, the advice I'd give is just don't give up. Like every stage of it, find a North Star, whether that's the vision or just even the day-to-day work of solving this problem, if it's your founder relationship, whatever it is, like find a North Star and don't give up, because you're gonna hear a ton of no's, you're gonna go through, every new thing seems impossible, but somehow it's like it flashes before your eyes and you figured it out. So yeah, just every step, don't give up.
That's the best advice, but I guess to say something different, I think the advice I would give to my beginning of the company self would be, while not giving up on the business, give up on ideas more quickly when they're not working. So that doesn't mean quit something in 2 weeks, but if something's not working after 6 months, be ruthless with yourself about why. And your big advantage over big companies is how fast you can move. Yeah.
Eric?
You know, if I could tell my younger self things, it's like, it's definitely, there's so much kind of fear. When you talk to people about startups, there's fear and risk, and am I going to do this and not? The answer is like, you're doing something for a period of time. You can be incredibly successful here if you believe in yourself, you really do understand the space you're in, you're focused, and you're able to shed a lot of the distraction in the form of things that aren't as important, but they're in your face, or requests that are coming from people that aren't necessarily the ones that are the most important to solve. If you can truly focus on the most important things and get them done, you have the route to success, and success is great. But that it's okay to go that route. It doesn't have to work out. There's so many people I know in the Valley who've done companies, they had something really valuable, they had product market fit, but they somehow didn't get to the next step. And all of them are really happy with that decision. They're happy they took the jump. They end up or land in good situations. Usually it's the kind of stepping stone to whatever they do next in their career. And really do understand that you can put your heart and soul into something, you can succeed beyond your wildest dreams, or you can get on to the next step in your life. But all of these things are worth doing, and definitely it's not something people regret.
Do we have time for
Yeah,
one?
we have a few minutes.
Okay,
Does anybody have any questions? We got a mic down here.
Should I come on down?
Yeah, whatever.
Whatever. All right.
If you have a question, line up behind the.
Hi, my name is Tony. Can you hear me?
Yeah.
Besides virtual reality, AI, or something to do with blockchain, what are the prospects for obtaining venture capital and support for other technology-related endeavors?
Do you have a person you want to answer this?
So for example, I have a software, but it's not related to those previous 3 categories.
You name the 3 flashiest things, and I've met companies that are doing the AR blockchain for, machine learning.
Exactly.
People here are building businesses. Like, these are technologies, and the technologies are a promise because they're novel and they're clear. There will be, really big businesses built around this tech, and this tech can also revolutionize existing, really successful businesses. But ultimately, if you're presenting an idea and you have the right background and you have the experience to build this and make something very, very successful, everybody's interested in that. You talk about what you were mentioning, Soylent and Airbnb and others. These are Uber, these are companies and businesses that existed in a pre-digital era. People have come up with a way to really change the dynamics of them in this space, and they've succeeded. And really, these technologies weren't the things that made this possible. It was the people, the teams, the hard work, and the vision.
So there's hope for things that are not like the red hot thing for today.
So like for us, we do HR software. I could rattle off 20 public companies that do the most boring stuff of all time, and I can rattle off none that do the 3 things you named. And so if you talk to, the thing that's exciting for venture capitalists is can something get to massive scale? And so the reason that a lot of these these hard tech areas that you talked about seem really appealing is because there is this promise of big scale, but with the sort of modern internet distribution and SaaS and just the size of these markets, you can also scale a boring old business too in venture capital ready ways. And it's kind of like he just said, it's like if you have the ability to build a big business, it doesn't matter whether you make accounting software or flying Bitcoin drones. Yeah.
No, there.
Just one more comment. I would also add that if you can disrupt a space, it doesn't really matter how you do it. So you don't necessarily need AI to disrupt a more traditional field. I mean, the example for us, we say that we want to map business or customer feedback to business actions and financial metrics. In a lot of ways, that's consulting. Do you necessarily need AI? For us, we see it as a way to enable it and make it faster, but that could also be something that's outside of those fields.
Yes, sir.
Yeah, thank you for the talk. It was very insightful. Quick question on what traction with users or customers did you have at what level of your funding stage?
Yeah, who's willing to start? Natalie?
So when we fundraised, we were a bit of a unique situation. We had some traction, so we had about 5 customers that liked the product. I would say that we had a long way to go before they said they'd love it, and it was a fully functional product, but we had an MVP that 5 were using. They were paying, which was helpful, and based on our burn, and we were actually profitable, so that also helped to go to investors and say we don't actually need the money. But yeah, that was kind of our traction at that point.
At our seed, we had users and real pilots, but actually they weren't paying. And then at our A, we were still under $1 million in revenue, but growing pretty quickly, and we had around 100 customers.
So for us, our seed round was pre-product, and then we brought our product to market, I guess, within 9 months after closing the seed round, which was ahead of schedule. But that was day 1, there's no customers, and even that product we brought out, we knew was MVP, and we wanted to spend a few more months on it before we even tried to market it. So when we raised our A, we had just started to get some customers on board. Even our first product is pre-revenue. We were working to build our developer community. And so, a lot of the feedback we had is around feedback from customers. Did we build the right product? Are we seeing all this? And we had really a good set of, our initial set of customers were really coming back with, they're validating the product that's been built. They're developing with it. They're giving us feedback. And that was the basis for the A and then the focus on how do we grow the business from here.
All right, good stuff, guys. I think we need to keep this moving. Can we have a round of applause?